At 2:47 a.m. Eastern Time, while you were sleeping, the global financial system cracked. Japan's 30-year bond yield didn't just move this morning. It exploded, up 6% in a single session. For context, that's the kind of move you see in Argentina, in Turkey, in countries where the currency is on fire. Not the world's third largest economy, not the biggest foreign holder of your government's debt. And right now, silver's trading at $94.87. Gold is sitting at $4,735. These aren't predictions. These are today's prices. And by the end of this video, you'll understand why silver at $95 is just the opening act. Here's what we're covering. First, what just broke in Japan and why it's your problem. Second, the trap the Federal Reserve just walked into. And third, why silver is the most asymmetric trade on the planet right now. Stick to the end because I'm going to show you the exact price targets that sound insane until you see the math. Let's decode this. Okay, Japan 101. Super fast. Japan has been running the biggest debt to GDP ratio of any developed nation on Earth, over 260%. How did they keep this alive for decades without blowing up? Simple. They cheated. They held interest rates at zero, sometimes negative, for years. Here's why that matters to you. When you can borrow money in Japan for basically free, what do? You borrow yen, convert it to dollars, and you buy anything that yields 5%, 7%, 10%. U.S. Treasuries, tech stocks, Miami condos. Japan became the world's ATM machine. Free money, flowing everywhere. That ATM just got unplugged. When Japanese yields spike like they did this morning, two things happen at once. One, the cost to borrow yen explodes. Every hedge fund, every bank that was playing the carry trade, they just got margin called. They have to sell assets to cover. Two, Japanese investors, the pension funds, the insurance giants, suddenly have a reason to come home. They can now earn 5% risk-free in Tokyo. No currency risk, no overseas headaches. That's the magic number they've been waiting for. And here's where it gets scary. Japan holds over $2 trillion of U.S. government debt. They're America's #1 foreign creditor. If they sell even 10% of that position to defend their own bond market, that's $120 billion of selling pressure, hitting the treasury market in a compressed time frame. When bonds get sold, yields spike. When yields spike, the cost to service $6 trillion in U.S. debt goes up. America is already paying over $1 trillion a year, just in interest. If yields jump another % or 2 because Japan stops buying, the budget breaks, the math stops working, and there's only one way out. Now I know this is dense. If you're still with me, drop a comment below. I want to know who's actually tracking this, because what I'm about to explain next is the part most channels won't touch. The Federal Reserve now has exactly 2 options. Door number 1, let interest rates rise to attract new buyers for the debt. Housing market collapses, regional banks blow up, economy, deflationary spiral. Door number 2, become the buyer of last resort, print new dollars, buy the bonds Japan is dumping. This is called monetizing the debt. It's the emergency exit, and it destroys the purchasing power of every dollar you hold. But wait, didn't they do this in 2008? In 2020? We survived, right? Fair question. Here's what's different. In 2008, in 2020, central banks coordinated. The Fed opened swap lines with Europe, with Japan. They printed together, cut rates together. The problem was global, so the response was global. But today, President Trump is threatening tariffs on 8 European nations over Greenland. Europe is discussing retaliation. European countries collectively own $8 trillion of U.S. bonds and equities. That's almost twice as much as the rest of the world combined. If political tensions prevent coordination, or worse, if Europe decides to stop buying U.S. debt as economic punishment, the Fed doesn't just have to print to cover Japan. They have to print to cover everyone. So, let me paint the picture. Japan, selling to save itself. Europe might stop buying to punish tariffs. China, already been selling for months. Who's left? The Federal Reserve. And their only tool? The printing press. That's monetary debasement at scale. That's the environment where hard assets stop tracking fundamentals and start tracking the speed of currency destruction. If you're finding value in this breakdown and you want more analysis like this, hit that subscribe button. We're tracking this story live. Now, here's where silver enters the picture. Let's look at today's scoreboard. Silver up 4, 38%. Gold up 3, 24%. Platinum surged 5%. Gold miners gapped up over 5%. But here's what most people missed. The gold to silver ratio briefly dropped below 50. Why does that matter? In a precious metals bull market, silver doesn't just keep up with gold. It outruns it. The ratio compresses when fear turns to panic. When institutional money starts fleeing bonds, fleeing fiat, silver moves faster and harder than gold because the market is smaller, the leverage is tighter. When miners confirm the metals breakout like they did today, it means smart money believes this move has legs, not a one-day spike, a sustained rally. Oh, and Bitcoin, down below $90,000 again, while gold and silver are hitting all-time highs. Interesting, right? When real systemic stress hits, when bonds are breaking and central banks are trapped, capital doesn't flow to speculative tech. It flows to the assets that have survived every crisis in human history. Gold and silver. Let me show you the pattern. Because it's happened before. Financial system collapses. Silver crashes from $20 to $9 in the liquidity crunch. Then the Fed announces quantitative easing. Silver goes from $9 to nearly $50, a 456% gain. Pandemic hits. Silver drops to $12. Fed prints $3 trillion in 5 months. Silver doubles to $30. The pattern is simple. Crisis, crash, printing, rally. We're currently in the things are breaking phase. Japan was the crack. The printing phase is not optional, it's structural. The Fed cannot let the treasury market fail. So where does silver go from here? We're not starting from $12 like in 2020. We're starting from $95. A double from here? $190. But let me show you the math that sounds insane until you understand it. If the Fed implements yield curve control, where they cap treasury yields and print infinite money to enforce that cap, the game changes completely. That's the surrender. That's when they stop fighting inflation to save the government. Here's the ratio math. Current gold price, approximately $4,700. If the gold to silver ratio compresses to 40 to 1, silver equals $117. If it compresses to 30 to 1, which we've seen in previous manias, silver equals $156. True panic? A 1980-style blow-off? 15 to 1. Silver equals $313. These aren't fantasy numbers. They're mathematical outcomes of a predictable sequence. Sovereign debt crisis forces central bank intervention. Intervention destroys currency confidence. Destroyed confidence drives capital into hard assets. The smallest hard asset market, silver, experiences the most violent price discovery. But here's what you need to understand about the path from $95 to $150 or $300. It won't be a straight line. There will be days where silver drops $5. There will be margin calls, forced liquidations, hedge funds selling their winners to cover their losers. These are shakeouts. They're designed to terrify you out of your position. The banks who are short paper silver need you to panic, to sell your physical metal, so they can cover their exposure. If you're holding physical silver, the actual metal, not leveraged paper, you can survive the volatility. The only people who get destroyed in a bull market, the ones who panic at the bottom of a temporary dip and sell into the hands of institutions covering their shorts. Let me bring this home. The macro setup right now is perfect. Pillar 1, industrial demand that cannot be met. Solar, electronics, AI infrastructure, structural and growing. Pillar 2, geopolitical fracturing. The Western alliance is cracking. Coordinated responses may not come. Pillar 3, monetary desperation. The Fed is cornered. The only exit is the printing press. The only thing holding silver's price down? Paper manipulation. And paper burns when sovereign bonds are breaking. The butterfly flapped its wings in Tokyo this morning. The hurricane is forming over the Treasury market, and silver benefits from both the storm and the response. Hold your position, ignore the noise. The math is playing out. If you want the deep dive on why paper silver manipulation is about to break, watch the video on screen right now.